Hello, and welcome to the Fin Know-How Foundation course on the time value of money. Time value of money is a fundamental concept in finance applied in very routine settings, such as in analyzing a loan or a mortgage, to all the way to highly complex financial analysis around derivative securities, mortgage-backed securities, and so on. Okay? So it's very important, therefore, to have a strong conceptual understanding of the concept of time value of money. And that's what we're going to cover in this lesson, in this video. So we will go over a few basics concepts, such as primarily why a dollar is today is worth more than a dollar tomorrow, and how to quantify it, because that ability to quantify it becomes a very important skill in evaluating investments or projects and making informed financial decisions. We will go over the practical calculations itself in quantifying the time value of money. We will look at certain cash flow patterns that allow us to simplify the calculation of time value of money. And then finally, we will look at certain applications. So let's start with the basic concept. And that concept essentially says that if you had to choose between a dollar today versus receiving the same dollar 1 year from now, the concept of time value of money says there is value to having the money today, or there is the fact that you would receive a dollar 1 year from now causes that $1 to be less valuable than the $1 that you have today. And the conceptual framework behind time value of money allows you then to quantify the loss of value from the delay in receiving a dollar 1 year from now. So as you can imagine, whether you're looking at a business that pays out, generates cash flows and profits over a period of time that you will receive later, and you're making the payment for it today, you have to compare what you pay today to what you can expect to receive after adjusting for the time value of money. And so the business decisions, to a great extent, are informed by the time value of money. So in the calculation of time value of money, there are two ways or two aspects to the calculation. One aspect is forward-looking, where you have a dollar today, you invest it in something that generates a payoff, but the payoff is realized at some point in the future. The question is, if you know what return you're going to get, how much will that initial investment grow to by the end of the period? That type of time value of money calculation, where you're trying to quantify the growth in value as a result of the investment, is called a future value calculation. We will also look at a present value calculation, where we will look at the loss of value that comes from the delay in receiving the payoff at a future date. But let's start with the future value calculation first. So again, future value calculations involves taking an investment that you're making today, allowing it to appreciate or grow in value due to the return it generates, and you're trying to figure out what that initial investment is worth at a future date. Specifically, let's consider a business example. You have $100,000. You're investing it in a 5-year project, and the project is expected to generate a 10% annual return. So formulaically, this can be written as future value is equal to the present value, or the Actually, I should correct this while I see it here. It's the current value times the growth factor, which is the rate of return that you realize from making the investment, adjusted for the time period over which that rate of return is realized. So formulaically, it looks like future value is equal to the current or the present value times 1 plus r raised to the power t. If you do the math on the right-hand side, you can see the $100,000 growing at 10% over 5 years yields $161,051, or it has grown roughly $61,051 over that 5-year period. Now, some of you are going, I can see the math. I'm not particularly comfortable with the math. I understand the logic, but I would love to be able to do this calculation without having to compute the results using this formula. So not to worry, there is an easy way out, and that's what I'll show you next. So what I'm going to do is illustrate this, an easy way to do this computation without having to go through the algebra that you see on the screen. And for that, I'm going to share with you the screen, and specifically, let's look at the area that I've highlighted. Here, I'm trying to compute the future value of $10,000 invested over a 6-year period, growing at a rate of return of 10%. Formulaically, like before, you would have said 10,000 times 1 plus the rate of return 10%. Exponential 6, meaning it's growing at the for 10% for 6 years, I would have gotten 17,716. But I can actually do this math a lot easier using AI tools. So for instance, I'm going to take this portion, which is essentially my question, and I'm going to open up Copilot, which is the embedded AI agent within Excel. I'm going to paste this question into Copilot, and I hit enter and look at what it does. It takes a minute, does the calculation, and tells you that the future value is $17,715.61. Right? And it shows you how it is computed exactly like I have done. It shows you that the amount invested is 10,000, rate of return is 10%, the growth rate or the exponent is 6, and you get 17,000, 17,715, which is exactly what we got. Okay, so so you can see that you can do this calculation very easily without having to go through the algebra here. Okay, so now I'm going to switch to the present value calculation. So this present value calculation is the reverse of the future value calculation, right? Where we have an amount, a payoff that you're going to receive in the future, and you're trying to figure out what the value today of that payment that you're going to receive in the future is. Like in the case of future value, the factors that drive it are the rate of return that you would expect and the time horizon over which, or the delay in receiving the payment. Now, one thing to keep in mind is that the interpretation of the rate of return in a present value calculation is interesting. Because what it is that if you compare a dollar received today versus a dollar received 1 year from now, the difference is that if you had the dollar today, you could invest it today and earn a rate of return. And if that rate of return is more than 0, you're going to end up at the end of 1 year with a number greater than $1. So the fact that you have the opportunity to invest the dollar you have today to realize a rate of return is called the opportunity cost of that dollar. Okay. Again, to repeat, one of the benefits of having the dollar today is that you can invest and generate a rate of return. So if you want to give me a amount later, it has to be at least as high as what I could have gotten with my alternate investment. And so that is the interpretation of the rate of return in a present value calculation. So let's look at this practical application problem that I have on the screen. You have an opportunity to invest in a deal that will pay you $500,000 in 3 years. If you require a 10% return per year, in other words, if you have alternate opportunity or the opportunity cost of your capital is 10%, then how much is that $500,000 received in 3 years worth to you today? The way the math works is that you take the future value, the $500,000, and divide it by 1 plus the rate of return or your opportunity cost of your capital or your required rate, and then raise it to the power of the number of years of the delay. So the calculation would go in this particular example as 500,000 divided by 1 plus the 10% or 1.1 to the power 3 because it is 3 years. And you will see that this calculation will yield you a number which is $375,657. In other words, the value of the $500,000 received 3 years from now, if calculated as of today, is only 375,657. Or put differently, you lost on slightly less than $125,000 in value because of the delay in receiving the $500,000. That is, if you had $500,000 today, that can generate a 10% return, or put differently, by getting the $500,000 only in 3 years, you're losing $125,000 in value. And this is why, because of the reduction in value or the discounting of the value, this is why the rate of return used in present value calculation is often called the discount rate. That's where the term discount comes from. So again, the discount rate is your opportunity cost, what you could earn elsewhere with similar risk. Of course, if your risk is higher or your investment is different than what you're considering, your rate of return may be also need to be adjusted to reflect the fact that you are dealing with a investment of a different risk profile. So again, as with the future value calculation, I would like to show you how to do this calculation using Copilot. And what I'm going to do is actually use the Copilot embedded within this PowerPoint slide directly. So I'm going to take the question. You have the same question that I have here. And I'm going to put it into Copilot. And ask it to compute. Let's see what it comes back with. It's taking a moment here. So it did the same calculation that I have here, 500,000 divided by 1.1 to the power 3. It came back with $375,000, 657, exactly the math I have here. So just to see how it, now cleverly ChatGPT or Copilot is asking me the question, would you like to see to see a comparison table as to what happens to the value as the discount rate changes, I'm going to say yes and see what it comes back with. Again, bear with me one moment while it does the calculation. Okay. So what you see here is, I'm going to expand this here a little bit. At 10%, it was 375,647. If your opportunity cost of capital is lower, meaning that you could not have earned 10%, you could have only earned 8%, then the present value goes up because the alternative is not as attractive as the 10% you had before. If, however, your opportunity cost, your alternate investments yielded even a higher rate at 12%, you can see the present value decline. Okay. So in any case, you can see how you can do the same math using ChatGPT or its equivalent chatbot to be able to do the calculation that we went through. The key thing to remember, you can do it either way. The key thing to remember, though, is that no matter how you do it, it's often helpful to have the conceptual framework in the back of your mind, because if the ChatGPT or the chatbot gets it wrong, your intuition will tell you if it is directionally correct. Okay. So if you're doing a future value calculation, you know the number has to be higher than the amount you invested, and how much higher depends on the rate of return as well as the number of periods over which the return is realized. If you're doing a present value calculation, you know the number will be discounted, meaning that the present value will be lower than the amount you receive in the future. And it will be lower. How low it would be will depend again on your opportunity cost of capital, the required rate you might have, or the rate of return you can generate on an alternate investment. And it also depends on the time horizon over which the discounting happens, or the time horizon associated with the delay in receiving the payment relative to today. So long as you have that framework in mind, I would feel very comfortable with you doing the ChatGPT calculations. You know the formula, it's available for reference, but using the capabilities built into a chatbot saves you time and effort. Okay. So now that what we have done and the two present value and future calculations in concept, and you have a sense of what drives the value, I want to share with you a couple of patterns that you see in cash flows that you can exploit to make your calculations easier. So let's say instead of one payment like we have here, we had a series of payments. Then if you can recognize that series of payments to have certain patterns, there are simpler formulas that you can use rather than having to compute the present value of each cash flow separately. So I'm going to start with an example. Let's say you just won the lottery and you have an option of receiving $1 million today versus a series of payments that extend over the next 25 years. Every month you get a payment that is, or let's keep it simple. Let's say every year you get a payment, and that payment is spread equally over 25 years. That initial $1 million payment you can get as one alternative is what you call a lump sum payment. It's a once and done kind of transaction. You get paid the amount and you're done. Annuities, on the other hand, are similar to, are in fact the equivalent to the series of payments that you might choose in a lottery. So instead of getting one payment, you choose to have the payment spread over a period of time, equal payments across a finite period of time. So in this case, it might be, let's say, $100,000 over 25 years. Okay. That would be an annuity. Now, if those payments extended into forever, meaning that there is no finite set period, so instead of receiving it for 25 years, you receive this forever, that would be a case of what you call a perpetuity. A perpetuity is an annuity without a time limit. Okay. In the business world, you often see this in the case of what's called preferred stock. It's kind of a stock which pays out a dividend and it pays it into perpetuity. There are not a whole lot of preferred stock issuances which have the profile, but certain established companies that have been around for a while often have those kinds of stock issued. In contrast, an annuity might be like if you are leasing your car. Rather, you get your car today, and in return, you make a series of payments, equal payments every month for 3 years to have access to the car, right? So that series of equal payments made every month for 3 years, so 36 payments of, let's say, $500 each, that would be what you call an annuity. You can have other patterns. One other pattern that's often utilized is when you have a series of payments. The payments are not the same, but they're growing at the same growth rate. So for instance, if you were to buy a business that grows, let's say generates $100,000 in profit every year, if it grows at 10%, the first year's profit would be 100,000. The second year's profit would be 100,000 growing at 10%, so it would be 110,000. The third year's profit would be the 110,000 growing at 10,000 would make it 121,000 and so on. So it's not the amounts being the same, but it is the growth rate of the amounts being constant. So why is it that we consider these kinds of patterns? It's again, like I noted a couple of minutes ago, it's to help you figure out a shortcut methods or formulas that you can use to simplify the calculation instead of having to do each one separately. So for instance, if you have a calculation, if you have a series of payments that extend into 100 years or into perpetuity, it's virtually impossible to sit and manually calculate the present value of each of those cash flows. And so these formulas become very handy when you have circumstances of that type. Now, we are going to start with annuities. Now, it turns out that in the case of annuities, you can calculate the present value. So let's say this is a lease payment on a piece of equipment, and you have to make annual payments of a fixed amount, and you have to make it over T number of years, then you can use this formula which says that present value is equal to the annual payment or cash flow per period times what's called the present value interest factor of an annuity over with a discount rate of R and a time period of T. So like before, let's use an example. So you have an equipment lease, which is $50,000 in annual payments for 5 years at an 8% discount rate. What we're trying to find out is the present value of the 5 payments of $50,000 if the discount rate is 8%. So when I do the math, I do 50,000 times present value interest factor, 8% for 5 years, which is 3.9927 times the 50,000, I get this. Now, where did I get this 3.9927? Turns out that again, the AI agents chatbots can help you with that. So all I'm going to do is I'm going to type in PVIFA 8%, 5 years. And I'm going to say question mark, and I'm going to have it do the calculation. And it comes back as 3.9927, which is exactly what I have on the screen. And it also does the calculation because it is already in PowerPoint and it can see that I'm working with the math here. It went ahead and applied the $50,000 to the 3.9927 to give me 199,365. Actually, I should say 635. I think I have a typo here, which is exactly what you see on the screen here. Okay. So again, same calculation. I can do it in manually, and I can look up this interest factor very easily. Even you don't even need a chatbot. If you were to do this in Google, you will get exactly the same result. Okay. Okay, so we have done the calculation for annuities. When it comes to perpetuities, it turns out the calculation becomes very simple. So rather than have a complicated formula, all I have to do is that if it is a perpetuity, again, in the case of a perpetuity, the time horizon is infinite, right? It's not a certain number of periods. So the term T that you see here doesn't have an analog here because it extends into perpetuity. T is infinity in this case, right? So all I have to do is take the annual cash flow and divide by the discount rate. So in this case, if you have a preferred stock that pays $8,000 annually forever with a 10% required rate, the $8,000 gets divided by 10% of 0.1 to get me 80,000. Again, just to be sure that you can do this using a chat bot, I'm going to take this piece and I'm going to paste it in here and ask the question, and guess what? It came back with the same $80,000 that I have here today. Okay. Now I'm going to switch to the last type of cash flow patterns that I want to discuss, and that is cash flows which are growing. And this kind of a pattern comes up often in the valuation of businesses. That's why I'm bringing this up. So here you have a cash flow of a business that generates $200,000 annually. And notice here that the profits of the business are expected to grow at 4% annually, and the required rate of return is 12%. So here, the formula says it's similar to the perpetuity formula where you divided the cash flow by the rate of return. Here too, remember it is extending into perpetuity. The only difference is that I have to adjust for the growth rate. So in the denominator, I have to subtract the growth rate from the discount rate. So here, the $200,000 annual profits growing at 4% means that I have to divide the $200,000 by the required rate at 12% less the growth rate of 4% gives me $2.5 million. Okay. In other words, a business that generates $200,000 annually but growing with the profits growing at 4% is worth $2.5 million if your required rate is 12%. Okay. I, as before, I'm going to use the chatbot to do the calculation for me. I'm going to put this in and say, what is the value of the business? And does its math. Uses the same formula, uses the same inputs, and it gives me a value of $2.5 million, which is what we have here. Okay. Now, if it turns out that the cash flows from the business doesn't grow forever, it grows for let's say 10 years, I'm going to take the same question, I'm going to change it to represent that and see what ChatGPT can, how ChatGPT can help us. The life of the business, I'm going to restrict it to is 15 years with a required rate of return. What is the value? Is only 15 years. What is the value of the business? Let's see what it comes back with. What it is doing in this case is computing just the present value of all the cash flows, individual cash flows over a 15-year period. There is a formula that goes with it. It's a little more complicated. That's why I didn't want to lose you in the detail here. As you can see, the formula is a little more complicated. And because now the life is only 15 years, not forever, the value is no longer 2.5 million, it's 1.68 million. Okay. So hopefully you can see how these formulas work. The formulas are not particularly complicated, but if you are uncomfortable doing the calculations by hand, you always have the option of relying on a chatbot to do the calculations. The only thing I would urge you to have is urge you to do is to think about the problem ahead of time before you put it into ChatGPT, or its equivalent, so that your intuition about the direction or the quantum of the value is generally your intuition can be used to test the conclusion that the chat bot comes back with. Okay. All right, so that was a lot we covered. So here are a few more examples of this. Again, I will note what I can about each of these problems quickly, and then use the chatbot to do the calculation for us. Company generates $300,000 in annual profit, growing at 5% using a 15% discount rate. The formula would be 300,000 times the required rate minus the growth rate. Straightforward calculation, you get 3 million. Again, I am just going to run the calculation through the chatbot. It should come back with the $3 million in value that we see here. Okay, here we go. It came back with a 3 million, right? Another example is you're borrowing 800,000 at 6% for 10 years to buy a business. Annual payment calculations uses the annuity formula. The result is approximately 108,697. How did we get that? Right? So the present value of the payments that you make on the loan at 6% over a 10-year period. So it's an annuity of a certain amount that's paid every year for 10 years at every year for 10 years. If we were to present value it at 6%, what is the resulting value, right? That has to be 800,000. And so we will try to figure out what those payments would be. So what you're going to do here is that I'm borrowing it at 6% to buy an annual payment, compute annual payment using annuity formula. It'll do the math for you. It knows to use the annuity formula, which was the as you have here. So you're going to use the annuity formula, which says that the present value is equal to the annuity payments times the present value interest factor. So it goes through the math here, and it comes back with an amount, the annual payment amount of $108,694, which is exactly what we have here. Okay. And the last question here is that do you choose between $1 million today or $100,000 annually for 15 years? That, of course, depends on the discount rate. I'm going to do this. Assume discount rate 8%. It does the math. And on the left-hand side here, of course, I'm using the annuity formulas here because I've got an annuity stream of $100,000, equal payments for 15 years, and a discount rate of 8%. And when it does the calculation, it gives me 855,948, which is exactly what I have here. Now, to illustrate what happens to this value at discount rate, I'm going to do, as you can see here, at the different discount rates. When I run it at the different discount rates, I can see that if my discount rate is higher than 8%, what happens to the value, and what happens to the value if it is less than 8%. Hopefully the table should pop up any moment now. Come on, here we go. Okay, at 4%, I would be better off taking the $100,000 because its present value is more than $1 million. At anything at 6%, it is less than $1 million. So at a rate above 6%, I'm better off taking the $1 million today. Now I'm curious to see at what rate am I indifferent between the lump sum and the annuity options. Okay. Let's see what it comes back. We know it is more than 4%. At 4%, it's the lump sum is preferred. At 6%, the annuity, sorry, at 4%, the annuity is preferred. At 6%, the lump sum is preferred. We suspect that it's a number between the two. So I'm just going to run the calculation, and it'll turn out that you will see in a second the rate at which you're neutral between the two options is 5.56%. In other words, if your opportunity cost of capital is only 5.56% exactly, then it wouldn't really matter in a present value sense whether you receive the $1 million today or the 100,000 annuity of 100,000 over a 15-year period. As you can see, you've got exactly the same number as I have here. Okay. Again, just to think through what we just did, we recognize the type of payment, whether it is a lump sum, whether it's an annuity, whether it is a perpetuity, whether it's a growing stream. We take those fact patterns and then do the present value calculations, and that's how we get to the answers to each of these questions. And you also saw how to use a chatbot to be able to compute those answers for you. Okay. There are many tools you can use, but as time has grown, and even in my classroom now at the university, I encourage students to use the chatbot tools that are available. But the key thing is to make sure you understand the conceptual basis of these calculations and what factors causes the numbers to go higher or lower. So again, to recap, the time value of money concept relates to the fact that there is a difference between receiving $1 today versus $1 at a different point in time. The difference is related to what you can do with the money in the interim period. And that in turn depends on the rate of return you get from making an investment and the time horizon over which that investment is made. We went through different types of calculations. We did future value calculations and present value calculations, and we also went through adaptations of those calculations to cash flows, to certain kinds of cash flow patterns. And we also figured out that the formulas don't require too many inputs. Still, if you want to avoid computing the present value or future value manually, you have the ability to ask the same question of the chatbot. And the only thing that we should keep in mind is we should have an understanding of the factors that drive outcomes, so that We can test the reliability of the answers provided by the chat bot using that logic. Okay. So that completes this video on the time value of money. This is a concept that has many layers and many nuances, but I have tried to synthesize it to its core elements and give you what's should be good enough for you to be able to do the rest of the materials in this course. As always, if you have any questions, do not hesitate to reach out. Hopefully you have found this lesson useful and easy to understand. I look forward to seeing you on the next lesson. Thank you for your time.